Hello everyone, welcome to Simplii Finance. In the last video, we understood how convertible debt impacts the EPS. Those who have not seen the previous video, we are given the link in the I section above. Kindly click and check it out. Today we'll be discussing on how ESOPs impacts the EPS. In this video, we'll understand on the treasury stock method and how the ESOPs conversions will increase the stock holdings and reduce the EPS. Make sure you take down your notes and let's get started. We are still in the diluted EPS section of the reading, and now we are looking at ESOPs. This is the final convertible security according to the curriculum, and now we'll still be looking at the diluted EPS and we'll be using the what if convert method. So here we have a sample example. So we have a 2.3 million USD and we have a weighted average common shares of 1 million, and at the beginning of the year we had 30,000 ESOPs at an exercise price of 20, and over the fiscal year the market price of this company averaged to be 55. So here when I use the what if converted method, what I want to understand is what if the ESOPs gets exercised. So you have totally 30,000 ESOPs and you will be paying an exercise price of 20. So this will amount to 600,000 USD in value. Now the average market price is 55. So number of shares which can be bought at this rate will be 600,000 divided by 55. That comes up to be 10,909 shares. But I have a commitment of 30,000 shares, assuming each ESOPs gets me a share. So with this money I can only get 10,909 shares. So additionally I have to infuse 19,091 shares into the market so that I can cater to the commitment of 30,000 shares. So in the diluted EPS, let's start with net income. That will be 2.3 million. And then there is no preference dividend here. So the numerator is still the 2.3 million and the weighted average number of shares is going to be 1 million plus this 19,091 shares. That is the additional shares which is going to come into the market if these ESOPs gets converted for me to satisfy this commitment. So this becomes the numerator, the denominator. So the diluted EPS in this case will become 2.31, 2.25. So quickly recap, we have seen three convertible securities. First was on the preferred stock, where what if the preferred stock gets converted? In the numerator you do not subtract the preference dividend, because you don't have to pay the preference dividend anymore, and the denominator gets increased by the conversion of this preferred stock. The convertible debt has again an impact in the numerator and the denominator. The numerator increases by the after tax interest expense, and the denominator gets increased by the conversion of equity shares from the convertible debt. The last convertible securities we saw is on the ESOPs. So we use something called a treasury stock method to understand what could be the dilution in the equity shares. So here, using the exercise price and the average market price, you will understand how much is the shares you can procure using with the exercise price in hand. So in this case, you had 30,000 options with an exercise price of 20. You got 600,000 USD with the average market price of 55. You could procure from the market 10,909 shares, but you had a commitment of 30,000. So additionally, you'll have to dilute 19,000 shares for me to satisfy this commitment of 30,000. So with this, we finish the ESOPs. But there is one small important concept called anti-dilutive securities. So what are anti-dilutive securities? Anti-dilutive securities are those securities which make the diluted EPS to increase. As a general rule, the diluted EPS has to be lower than the basic EPS, because that's the point of calculating the diluted EPS. What if the convertible security gets converted? Then by all logical reasoning, your EPS should fall down. The diluted EPS should fall down because of the conversion of equity shares. Now we have one small example for us to explain this concept. So let's first find the basic EPS. In the basic EPS, we have a net income of 1.25 million, and you had a preferred dividends of 250,000. So this was the numerator of a million, and the denominator, that is the weighted average number of shares, was 100,000. So the basic EPS comes to be 10. For the diluted EPS, assuming there is no more convertible securities, so the net income is the same. And what if this preferred stock gets converted? You do not pay the preferred dividends anymore. So the numerator is still this number, 1.25 million, and the denominator, that is the weighted average number of shares, again gets increased by 15,000. Okay, so the numerator becomes this number. So let's find the diluted EPS. So here the diluted EPS becomes 10.86. Now since the diluted EPS is 10.86 and the basic EPS is 10, as a rule you simply strike this diluted EPS and replace it with the basic EPS, and this security will be called as anti-dilutive. Okay, and for all practical reasons, for the price earnings ratio, the earnings per share should always be the diluted EPS only, to be more conservative. Moving on to some small other concepts in this reading. that is non-recurring items. So we have some changes in accounting policies that is based on accounting standards. Any changes in the accounting standards or in regulatory requirements, you are supposed to change it on a retrospective application. When I say retrospective, it means from the date of change, all the previous financial reports also should accommodate for that change. And changes in accounting estimates, again this is based on the management's decision. So this should have a prospective change. When I say prospective, from the date of change. For any other reports, from the date of change into the future. And prior period adjustments, this is a big red flag. Prior period adjustments means you are saying that your previous financial year's annual reports, some of the numbers were wrong and you are trying to correct it. And this could be something like error in amortization calculation of goodwill. So this is a big red sign because their accounting controls are not in place. Their internal controls are not in place. And here the common size income statement, this is not the balance sheet, the common size income statement, what we are trying to do here is we are trying to compare two companies, but just by seeing the absolute values you might not get so much of information that you would like to. So what you do, you simply divide each of the number with its sales to get a relative percentage. So here 70% goes to the COGS, it means you are getting a 30% gross profit versus the South company here gets an 80% gross profit. So if you see on the absolute number, even though this company has a lower absolute number, the gross profit is quite interesting here to see. And if you see the research expense here, it's quite small compared to the other company, but this company only spends 5% on the research, whereas the South company spends 20% on its sales on research, which is a significant amount. Apart from this, some other important things given in the reading is on the gross profit margin and the net profit margin. So these are quite self-explanatory. That's the gross profit by sales and the net profit by sales. Now how do you use this in real life? So we have taken the annual report of Hawkins Cookers and we want to understand, just by seeing their income statement, many different things. First thing is on the revenue trend. So the revenue trend is how the year-on-year growth of the revenue of this company is going to be looking like. And we are just taking numbers here and we see that the 5-year sales for March 23 ending was 12.7. Is it good, bad? This has to be compared against the industry average. Next, we just try to compare the profitability aspect, and here we have the gross profit of Hawkins Cookers, and we also have how this gets converted into the net profit number. We have a impressive 40% gross profit margin, and you see the previous year, that is March 22, has a lesser gross profit, which is we need to see this number more in detail, this red flag. And now we try to understand the common size income statement. So we just try to compare two companies, that is Hawkins Cookers and Prestige. So this is their absolute numbers. You can see that Prestige at that time had significant values in sales, almost twice, and this on absolute number basis, it's quite difficult to find out where the money is going. So what we do, we compare each of the item with the sales. So as you can see, Prestige has more of raw materials. So what happens, their operating profit, even though is so here the operating profit of Hawkins is much better than TTK Prestige. So this shows that they are little efficient in managing their gross profit or the operating margins also. So here you see also the dividend payment is quite bigger compared to TTK Prestige. So whatever we are trying to do here, we are trying to ignore the noise of numbers. and just see everything from a relative aspect. And here you can see that selling, here the Hawkins has spent almost 11%, but here TK Prestige is putting more on their selling expenses. So this throws into some light rather than seeing just the absolute numbers. With this, we are finishing the income statements reading. We'll follow this up by doing some examples and problems for us to practice more. Okay guys, I hope today's topic was clear and easy to understand. If you have any doubts or questions, drop your questions to the comment section below, or feel free to DM us to our Instagram ID given below. Don't forget to subscribe and turn on the bell icon so that you will be notified whenever we upload the next video. See you in the next video. Thank you so much for your time and patience.